All right, you guys. So I want to talk a little bit about this AMC play a little bit more because now you're finally starting to see maybe people talk a little bit more about liquidity in terms of banks. I know Lou dropped a video talking about how liquidity could be the issue with First Republic and that they're holding trades and stuff. So as you can see right here, hedge funds and alternative investments, right? So this is First Republic's website, right? It's not anything made up. It's not a mock-up. You know, one of the things that I talked about in my previous videos is that the connection is that this is really a bank liquidity play now with AMC. Why? Because the banks are the ones that are supplying the lines of credit. They're extending them monies to be able to go ahead and short this. And as you remember, if you've seen the other video, my AMC video where I talked about hedge fund risks, actually being the risk coming from the bank, and then the banks having counterparty risk with each other, seizing up those credit markets and having that credit freeze. So like I said, this is really a liquidity driven stock right now. It's great now that we have this court date pushing out the case so that they can't do this reverse split yet. And yes, the cost of borrow is going to go up. But one of the things is that there's going to be all this external pressure being put on that stock and pushing this pressure for the hedge funds. And it's going to come from this liquidity, this lack of liquidity that they're going to have. And like I said, it's a black swan event. It's going to come in. We don't know where the credit event is going to come from, but we know that they're trying to save First Republic right now. Why? Because First Republic obviously has a foothold in some of this risk analysis that they have in terms of being able to supply money to hedge funds, and whether they're holding trade execution somehow or whatever in the back office, they're taking part in this. But obviously they're not the only bank. So we want to look at what are other banks that may cause this liquidity crunch that handicaps these hedge funds. So we're going to pull up some information. All right, so here's some of that information that I said we're going to pull up. So this is coming from TREP data. So TREP data, TREPP, that is data that is coming from a data analytics company for commercial research. So I'm going to show you that right now, and I'm going to show you some of the banks that have that exposure. So as you can see here, this is their spring issue. This is their first quarter report coming from TREP data on the commercial real estate side. Okay. So right now, the information I'm going to show you is these are banks that are originating loans in the commercial real estate space. Now, if you know anything about the commercial real estate space, you know right now that the office complexes are the ones that are defaulting. Those are the ones that are in trouble. It's basically right now in terms of distressed assets, you have office, and then it goes to retail, and then it goes to multi-use, multi-residential. Okay. Industrial is in there, but industrial really it's not, they're not defaulting. Most of the defaults are coming via the office space right now, but you will see that trend down into the retail space. You probably won't see it very much in multifamily because people, you know, that's where they live, right? So unless they just, their situation is just so horrible that they collapse and the person's got to move back and go to their parents' home, you won't really see any major losses probably coming from that portion of their loan portfolio. But look at this here. So look at this. This is a top CMBS loan contributors. So we're going to look at these companies first. Look at the companies. Goldman Sachs, Wells Fargo, Deutsche Bank, which we know Deutsche Bank is very involved in the derivatives market, in the credit markets. Of course, Goldman Sachs is too, but Deutsche Bank is one of the banks that I'm curious is if they will actually survive this next downturn. But you got Deutsche Bank, you got Citibank in there, Bank of Montreal, you got Morgan Stanley. Obviously, you know Morgan Stanley took money. They turned into, just like Goldman Sachs, they relabeled themselves or part of their units into a bank so that they could receive bailout money from 2008, right? Then you've got Bank of America in there, and you got Barclays Bank in there, right? So Barclays is another player in the credit and debt derivatives market. Now the key is look at the loan amount, look at the number of loans, and then look at the market share. So we're going to go for the top three, right? So the top three market share is Goldman Sachs, Wells Fargo, and Deutsche Bank, right? Now look at this is the quarter one loans, right? So this is what they have currently on their books. So Goldman Sachs, in terms of balance, that's balance in millions. So that they have 1.3 billion. Wells Fargo has 1.2 billion. Deutsche Bank has 856 million. Okay, just shy of a billion. Citibank's got 631 million. That's a little bit over half a billion. Bank of Montreal, 615 million. Morgan Stanley, 612. Bank of America, 197. And Barclays at 122 million. Now, find that those banks are about to start having massive downturns on their loan portfolios, because most of those properties that they have, they're not retail space, they're office space. When you go for loans, these huge megalithic loans that they're going into, they're office space usually. They're not industrial, and they're not retail. They do have some in retail and industrial, but office is where they do the high lending at, right? Because a lot of times they're the only ones that have the access to the capital to do those loans like that, if they're not getting it from a specialized unit that lends for office, or they're not getting it from insurance carriers, right? So you guys know from my profile, I'm a life insurance agent, right? Well, guess what? Life insurance companies have tons of money that they lend to these huge office complexes in order to get those deals done and funded, so that they can have these offices built and maintained, right? They're the ones that are holding the paper, right? But the key here is that we got to look at these real estate losses that they're going to start getting on these portfolios, and I'm going to show you some data on that too. They're going to start to affect their credit and liquidity. So if it's going to start to affect their credit and liquidity, guess who else is going to affect? The hedge funds that they lend to. Watch this.